Good morning, dear students. Can you hear me clearly? Good morning. Can you hear me? Please answer yes or no or something. Okay, it seems like you are all silent. Are you able to unmute your microphones, or it's on my side?
Yes, we are able to unmute our microphones.
Oh, that's much better than just chatting. Thanks. Good morning. My name is Anton Shkuntov. I will be your teacher for this class, Venture Investments. I was told that it's more than 50 people who should attend the class. As far as I see now, there are less than 20. So I think we have to wait a little bit. In the meantime, you can start either chatting or just sound what you are interested in, mostly in venture investments, how familiar you are with that, etc. There will be a short poll, to be honest, actually, and maybe it's also will be a much better option. However, while we are waiting, just feel free to give any comments or requests. You're supposed to be the first year students, right? Okay, I will start. I see more and more people joining. Hope it's not a big problem to wait for several minutes. Just let me know when it's enough people in the room, and we'll start. I don't know the rules in your group, how many of people are usually in time or just visiting the classes. It's always around 8:30 p.m. I mean, okay, 20-30 people, sorry. So roughly half of the group, and we almost have it. I see people more. While we are waiting, who is in your group is the senior person? Usually there is somebody in the group who is called, I don't know, starst in Russian, no, something like that. Just somebody who is maybe one window to communicate with the group. Do you have a person like that? I see, Maxim. Thanks for commenting. I will provide some some comments on that. Of course, I will not share some particular commercial things, as it's a normal situation that you keep it quiet in the company. However, I will let you know about interesting things. Okay, shall we start? Do you think it's enough people in the group? Usually those who are in time or on time or just visiting, or we have to wait more? Okay. Let's then start. I see. I haven't changed the. Do you see the presentation? Please, starting from now, say something, not chat, because when I show my presentation, it's difficult to see the chat.
Yeah, we see.
Okay, perfect. So let's proceed then. Slightly some information about me. My name is Anton Shpuntov. I'm a CFA charter holder as well as CIPM charter holder. CIPM is Certificate in Investment Performance Measurement. So more number crunching and like contribution into performance, usually more liquid in the things. I have graduated from Higher School of Economics as a master, but actually I graduated from 2 universities simultaneously. And the first one is Moscow Institute of Physics and Technologies, which is in Dolgoprodny. My current employer is a holding company Interos, where I'm a head of investment funds and alternative investments analysis. So actually, I'm covering the whole spectrum of investments we have as a family office, and actually, it's from simple bonds to funds like private equity, venture, and fund of funds. That was my short background. I would be glad to know something about you. We need to get acquainted for me just to better understand what the pace of the lectures should be. Maybe if you let me know things you want to know after the course or other important information which I should know about you and your group, it will help me a lot in pacing the course and also in changing or adjusting the content of that. So maybe we will have a short get to know you, Paul. It's not Mentimeter, but at the moment I will start it. And please just answer it. 3 easy questions, but they will help me a lot in progressing with you together. I just have started. Have you seen the poll?
Not yet.
Yes, we do.
We see.
Okay, perfect. Just let me know. There are only 3 questions here. The first one is how much familiar with venture capital would you consider yourself? I don't know whether you know something or you're very much familiar or you don't know nothing about that. Okay, it seems like it's working. Your start answering. I will pause a little bit here. You're quite fast in answering that, actually.
Excuse me, it's quite unrelated, but is there any way to make your microphone a little bit louder because it is very quiet? Yeah.
I see.
Thanks.
Is it better now or not? Just let me know.
Very little bit. I guess we can take more.
What about now?
Perfect.
Okay,
Thank you.
Thanks.
Nice.
Yes, thanks for feedback. Just let me provide any comments or things just which makes our communication easier. Just don't hesitate.
Sure, thank you.
Okay, we have only 2 people left to answer in less than 2 minutes. I'm really happy. You're very fast with that. Okay. Only 2 people. Just we're waiting for 2 people. But I think I can comment already on what I've seen. It seems like most of you actually are not very much familiar with venture investments. However, there is one person at least who is very much familiar. Okay. With regard to visiting offline or online lectures, most of you actually prefer online studying, right? But some of you okay to visit offline, however, and mostly seminars. Okay, it's half of the group, right? Quite enough information. However, it's difficult to decide finally whether we should be fully online or I should visit university with you. And most of you are full-time employed, at least of those who voted. I see. Just one person left. If you hear me, I will be very much happy if you will just vote, and I will stop the polling. Perfect. Perfect. Thank you very much. Yeah, full time. So it seems most of you are already employed, but not in venture or private equity. Okay, I'm stopping the poll. Thank you very much. It helps me. And this is our result. Do you see the result?
Yes,
Okay.
we do.
Yeah, thanks. Just comment by voice. Okay, it seems like you heard something about venture. You prefer online, and most of you are fully employed. Okay, if that's perfect. So let's proceed then. The way we could be studying, it's online lectures, it's seminars, or online seminars. I think we still have to decide. I'm ready to visit the university from time to time if you will be visiting that. Just I don't want the situation to come to the university, and most of you would prefer that online. So please decide on that with the university, and we will finally choose the option. You will be supposed to read in books, articles, and white papers by yourself. Of course, I will be providing some links. I will be providing you materials, mostly lectures. But as far as you know things very well only when you do it yourself, right? Lecture, it's only the start of something. And there will be a couple of cases. Most of them will be written, but one will be deliverable. It will be a situation when investors will have to choose on how to finance a company, but that will follow in the next classes. From time to time, I will have polls like that. I hope they will help me, and maybe they will help you. We will be several tests. They will be ad hoc, they will be short, and most of them will not count as a part of the mark, of the final mark, but they will let me know if I'm good enough in providing you with knowledge and information, or I have to adjust something for you to better get that. Cases and white papers I already mentioned. One case will be with deliverables, and there will be, of course, final exam, which, as far as I get, we still have to decide whether it will be online or offline. If you have information, please share. At the moment, I don't have information about that. I'm ready to make an online exam. I did it last year. That went almost perfect. However, it's up to you because you are the group. This is approximate weights. I might adjust them slightly, but more or less it's class participation, and the quality and quantity of your comments will also count. It will be an intermediate test and a case study. Together they provide a quarter of the final mark, and half of the mark it's the final exam, which will cover the whole course. Yeah, you are supposed to apply quite large effort to self-educate yourself in addition to lectures. To have a good mark in the end, lectures is not enough. I might assign additional scores to students who will have made the presentations on some specific points. However, just let me know if you really want to have this option on the table. We can skip that. actually, but that's an option for those who are really interested. Okay, just a moment, please. Sorry, that was a technical issue. My daughter came and do you see my, okay, you can see my video. At least we will change that. Okay. I hope you see me again. Our main tool will be Zoom, and materials and links will be stored in Google Classroom. Soon I will share with you the link. But to be part of this Google Classroom, you actually need to have a Gmail account. I hope you have that one. We might use Microsoft Teams. That was an option last year, but I'm not sure how it's done at the moment. You can please let me know whether it should be LMS, MS Teams, or you are fine with Google Classroom. Convenient-wise, I think Google Classroom is the best option because I tested that last year and it works perfectly. However, again, it might be another option. And we have several rules. We have mutually respect each other, and our online sessions should be constructive without any abstraction and Zoom bombing, as they say. And I really encourage you to be more interactive rather than just being silent without videos. It helps me, it helps the group, and actually it helps all of you to get the better feeling of the subject during the classroom. Okay, this is the structure of the course, the whole course. That's the major blocks. We will touch venture capital basics, which is the topic of today's lecture. The next will be is venture capital fund. What is that? How it's structured? We will touch upon limited partnership, LPs and GPs, which are limited partners and general partners who manage the funds. Separate part is returns of venture capital investments. It's not that easy as it might be seen from first glance. We will touch upon the investment process of the venture capital fund. If we will have enough time, we will cover the basics of startup and the role of the founder. In that it's a off-topic, at least in the CFA curriculum, but I think it might be quite interesting for you. Of course, we will deeper in venture capital deal as a substance. We will know what types of securities are used, how the deal is being structured, what are the main points in the deal for all the parties in the table. And of course, the valuation aspect in venture investments, as far as you might guess already, it's something quite difficult. It's not a stock being traded on a stock exchange when you have a readily available price. It's more art than a science. However, there is a part of science in that. And maybe, yeah, that's it. This is the reading list. The required part is the curriculum of CFA Institute. As far as I know, Institute can provide you with that. Alternative investments and particular venture investment can be found in all levels by pieces, but most of the information is in level 2. It's alternative investments, and portfolio management block. It's study session 15 and reading 41. However, I encourage you to go through all the parts and read that. The major book which you should read in addition to the curriculum of CFA Institute, it's Venture Capital and the Finance of Innovation. It's really good book. It's not very new one, but actually I really highly recommend that. And it's available in Library of Higher School of Economics. I will be referring to that book with with some examples, and some of the tasks in the test and in your homework will be from that book. There are also optional books to read about if you have enough time or interest. They are all available in library of Higher School of Economics. It's entrepreneurial finance, venture capital. You see that here. I will of course share the presentation with you, and you can read them if you have enough time. But given that most of you are fully employed, I think maybe it's optional, and maybe not now, maybe in summer. There are also other optional books to read about. I would use them as something to go to, I don't know, expand your comprehension, or if you want to know about venture deals and particular aspects of that, and I will not provide you enough information on that, then you can read the first book. It's easy one. The other two, I think to read just to get a deep understanding of the industry. Please. This is the links in the web where you can find some information on venture capital industry. Pre-Queen is private equity intelligence. PitchBook is part of Morningstar since maybe last year or a couple years ago. CB Insights, a very good resource. Not everything is free of charge. However, there is enough information which you can use without paying anything. TechCrunch and Crunchbase are also some of those websites where you can find information about companies, industries, etc. And also you have several other things here, and it's not an exhaustive list. Of course, you can find other options. But if you're interested in the project, in the topic, I highly recommend the first 5. I think that will be enough. Okay, this is week 1, and we are starting. Today we will touch upon the venture capital as an industry. We will compare the industry size. I will describe you the history of the venture capitalism. It's not in the CFA, but I think it's quite important to know that. I will try to briefly touch the history of Silicon Valley and show you how the venture capital cycle, or how venture capital works. And actually, it's a nice white paper, very old one, but still very relevant. And I will provide you a link to that. And maybe we will have enough time to touch the basics of GPLP partnership model, which is mostly the topic of our next lecture. Guys, so far so good. Or just let me some feedback whether you want to make it faster, slower. I need some feedback. Okay, let's move on. If we consider alternative investment as a whole, it's only a part of the investment, right? So usually you have investment universe, and you have traditional investments. Traditional investments, you have modern and alternative investments, right? As far as you know, traditional investments are those which are stocks and bonds traded on the stock exchange, and almost every person in the room can buy and sell them, right? There are quite alternative investments you might be very familiar with. It's hedge funds, it's futures, it's distressed securities, and there are traditional alternative investments which are might be quite illiquid. However, it's private equity, commodities, and real estate, actually real assets and infrastructure at the moment. And our venture capital industry is a small part of this part of alternative investments. It's private equity. And if you look at the differences between the private equity investments and publicly traded securities, you can see them here on this webpage. But in general, it's easy. First of all, it's valuation. In publicly traded securities, you are a price taker. You have this price on your screen or wherever you trade. So the deal structure is standardized, valuations typically available, and there are no problems with the information on pricing. And the deal itself, it's easy, just buy and sell. And you usually have the common equity, bought or common equity sold. or preferred equity, both or preferred equity sold. In private equity investments, the deal structure and the price actually negotiated hardly between the investor and the company management, or maybe between the investors. Usually there are several of them. If we consider the aspect of information, availability and transparency, again, in publicly traded securities, you have a lot of publicly available information, and you can use only that to trade, analyze, and recommend. With private equity investments, I will be short with private investments. With private investments, investor can request access to all the information, right? You sign non-disclosure agreement usually, and you get much more information about the company and its nuances, and it might be even including internal projections by the management, etc. And you use that, incorporate that information in your decision-making process. After you made an investment in public traded situation, it's easy. You just do nothing, right? You just sit on the corporate boards maybe, or you just have your P&L in your application, and you have very much limited or no actual access to management. In private investments, investors typically remain heavily involved in the company. Usually, maybe you've heard about that, but in private equity, the whole deal is all about changing the company or situation in the company. And of course, there is a deep involvement of investors into the company, and they are presented in the board of management. They sometimes change the management, I'm sorry, board of directors. They sometimes change the management, they change the strategy, or just totally pivot the company into another direction. This is the nice picture from payqueen.com. It's closed-end private capital types of investments. And actually, as far as you see, there are two sub-blocks in that which are connected with venture. It's venture capital and venture debt. Venture capital is part of private equity, and it's one of the sub-strategies of private equity universe, right? The largest one is buyout. It was historically the biggest one, and it's still the biggest one. That's the classical leverage buyout deals, when you take the debt, you take the company, you buy the company, you change the management, and you try to make it much more expensive and sell it, or merge with other companies. Venture capital, it's usually investments in early stage companies without proven business models. They might have some prototypes, but more or less there is a high risk of losing your investment. Venture debt is one of the newest and growing parts of the universe. It's quite specific. Maybe we will touch that upon, but it's not the core topic of CFA curriculum for sure. But maybe I will be able to provide you with some nuances in comparison with traditional venture capital. If you're interested in that, just let me know, and I will make my homework on that. And there are other sub-strategies, which is growth. Actually, growth might be considered a part of the venture capital. It's an investment in late stage when the company has already proved its business model and it needs to scale the business very fastly. As far as you know from corporate finance, if the company is growing fastly, you need a lot of capital to build that growth, right, and to support that. And that's the growth investments. And all the others are quite different. To me, the most interesting, besides the venture capital, is private equity secondaries. It's usually it's a very growing market, which provides liquidity in this initially illiquid market. So usually when you make venture capital investments, you subscribe to the venture fund, and for 10 or more years, and you cannot get back your money. And in private equity, the same. Secondaries actually us providing the liquidity to those investors who can get out earlier. Of course, at discount, but it's quite interesting strategy, and I will let you know about that more later on when we'll get some important nuances on that. Okay, if we look at the private equity universe, the easiest picture, this is my picture. Sorry, I'm not a good portrait, or who is that? Somebody who can draw very nicely, but I hope it's quite understandable to you. So there is a private equity universe. It's part of the total alternative investment And in that universe, you have venture capital, which is smaller than the biggest and traditional buyout strategy. And that's a private equity. Quite important to understand the so-called S curves. It's the path of the business which goes from research study to maturity, and this is the S curve. In the middle, this is the innovation sweet spot, right? It's the point when you can have a product and which can go to the market, and you can have sales, and you can grow your company fastly. So usually it's new solutions to in the current market, or it's just new markets. And here we have short product life cycles, and it's very easy to enter the market at this stage still. But if you have this momentum, usually the company is quite successful. These are the stages and participants on this S curve. So consider this technology and company trying to capture on the technology. So at the start, usually it would be universities or research labs or national or corporate. And then when this S curves began to go fast up, you will have entrepreneurs trying to put money in the ground. And of course, venture capitalists who are people who are trying to find those opportunities. And the best case in the situation is to find some kind of gazelle. It's a company which is growing fast, despite the market things. I don't know, economy might go down, market go down, but this company will be growing. And sooner or later, it will become a mature enterprise, and it's not something what is what is of interest for venture capitalists. This is another picture. I will be giving you several pictures one after another. So the idea here, if at the startup, it's not a break even, there is only an idea, and angel investors are only participating. Usually, that's high net worth individuals, very much familiar with particular industries or people. They provide small amounts of capital to support the business ideas. If it's successive at the start, then we have an early stage where venture capitalists join. And as far as you might heard, there are different stages of finances. So usually it will be C stage, Series A, and etc. So still not big amounts of capital, but the company is continuing. And if we have a growth, so the idea is successful, the management is successful, the product market fit is in place, we have private equity guys coming in to the play with the much bigger amounts of capital. And in the end, the company becomes mature. Usually private equity guys are those who is exiting or selling this company to the public or to another strategic buyer. So that's in general. If you would look at that as a more mature part, as a early stage, late stage, middle market, etc., actually venture capitalists are at the start of this S curve. So it should be some kind of technological know-how. Usually venture capitalists, they of course buy minority positions. There is no sense in having, I don't know, 85% in equity of the company. And examples here, quite successful in different period of time. It's Yahoo, Microsoft, Google. You can put Facebook here. I'm not sure about Tesla from valuation standpoint. Of course, yes. From business point, we'll see. And then you have other strategies which are buyout and special situation and etc. This is quite sophisticated slide. Maybe I will not go deep into details here. However, if you will try to make it more granular, then you have several stages. So the companies, so the first one, it's early stage and it's seed actually stage. It's only an idea. So you have only first people in the company and they are developing the prototype or the idea. They just having several hypotheses. They testing that the market, which they don't know yet. Then if it's successful, the company moves into operation and starts getting some revenues. The first revenue usually comes from so-called pilots with some bigger companies when you just go and provide some service for some small revenue and the company, your client, try to test that. If it's of value, if it's successful pilot, usually those clients, the big companies, they subscribe the longer term contracts and for a larger amount of capital. And this is a nice milestone for the startup. Usually it becomes quite sufficiently more valuable after that and attracts additional money, usually from angels or maybe sometimes even venture capital investors. And yes, at the start, of course, it's only you. If you're an entrepreneur, it's only you, your money, and your friends and your family, usually. However, there might be some specific investors like angels who can provide ideas. Then you have an expansion stage, right? Before the company goes to IPO, which is quite rare, occasional, actually. Usually it's a trade sale to a bigger company or bigger fund. But usually before the final exit, there is a stage of revenue growth. And here venture capitalists and actually some strategic partners are investing in the company. We have venture capitalists across the full cycle, almost here, and that's quite important to understand. Usually you have to make several investments into successful business, into the companies. So usually venture capitalists, they invest first tranche, and then if the company is successful, it usually needs another round of financing. And if idea is good enough, the venture investor puts another money and then puts another money. So this is how it works. And below you see the purpose of those financing. In the end, it all goes to supporting the business idea, developing the market, testing the market. If hypothesis is positive and you have the feedback from the market, you might have so-called product market fit, and you start growing your company, trying to sell that in the end. If you look at that from the standpoint of cash flows, most of the life of the startup, and sometimes even further before after the exit, actually the cash flows are negative. That's why this first and the investments in the middle are quite important. The company still cannot pay you out. Of course, no dividends and no etc. The company only needs money in. And you have the concept of the product development, you put money, then you put additional money for operational rollout, then you put it for growth, for expansion, etc. So this is how it works by stages. And now we're coming to the summary of that. So actually venture investments are done in stages. On seed stage or startup stage, it's only about concept or research of the idea. Then on the next stage, which is early stage, you are testing your first product and you're trying to make some pilot projects with some potential clients. Then mid stage or expansion stage is coming, and actually have an established product and maybe even proved business model, you need a lot of money into working capital and into hiring additional people. And most of the capital on this stage goes for these goals. In the late stage, you need even more money and you need even more growth to make your business idea, still sufficiently attractive to the next stage investors and maybe to those who will buy it in the IPO or strategic investor. It's important to note here that each stage requires a different set of management skills, actually. So usually the person who starts the business, it's not the person who runs the business after the successful exit or the company became really, really big. We have several exceptions, like Facebook with Mark Zuckerberg, NVIDIA with its CEO, and several other companies are mostly exceptions. And yes, Elon Musk, of course. But usually entrepreneurs, they get out of the company. That's somewhere in the middle, because the skill set needed to continue expansion and make the company attractive for general public is very much different from the idea of researcher or developer at this stage. And most of those people starting businesses, they are not very much interested in that part. Usually they like to discover another new idea and then they go back, they start another idea, another startup, and etc. So so-called senior entrepreneurs. And that's important to remember. You guys, so far so good? Okay, we continue. What is the sweet spot for venture capital? So actually, we have a market ready for a new concept, first of all. So actually, we need some kind of, we have innovation, new approach to the market, new idea, and etc. They should be high growth potential, because if venture capitalists are not interested in something very nice, which doesn't grow with double-digit numbers for many, many years going forward. So the opportunity should be big enough, and the potential for growth should be also big enough. And it needs funding. So if it can fund itself, then you don't need venture capitalists in your company. So not all startups are supported by venture capital. Only those supported which doesn't have enough money, or the business models of those doesn't support the growth of the company. There are companies which actually do not attract the venture capital. They initially have business models or the pace of growth which allows the company to fund itself, or maybe just fund additional money from founders without diluting their stakes. And that might be, if the company is not growing very fast, but the founders are not diluted, they in the end can have much higher wealth actually. But again, if there is an innovation, big opportunities, and it needs funding, that's the sweet spot for venture capitalists. Okay, what are the goals of venture capital? So actually, they invest in growing innovative companies in which you have both the great potential of profit. However, the risk of complete loss of capital is also very much in place. So usually you will lose your money, or maybe you will get back something close to your cost. That's the nature of venture investments from statistical point of view. And it's important to understand that, first of all, the VC invests in good competitive industries, right, which are growing fast, and there is a capacity for 10x, I don't know, 5x, 20x of growth. Remember that S curve, so it should be somewhere in the middle. And only after that, guys, only after that, VC invest in good people and good ideas. I call it a myth. Maybe it's not a myth, but the idea here is the following. Look at the, I don't know, travel and leisure industry at the moment. It's beaten down to the ground, right? And you might have the best team, but most probably VC will not invest in it, because the industry at the moment is not something very interesting. It's not growing fast. It's not providing you with 5x, 10x in several years. And it's not on the S curve, right? But you might have best people in that. But it's not very interesting industry currently. It was a hot industry several years ago, for sure, but at the moment it's not. So that's maybe an illustration for you that actually the industry and the prospects of the industry are more important than people. However, the team is very much important. Sometimes even more important than the business idea itself. But if you go top down at the top, first of all, you will go to industries, to promising industries. Okay, and it's important also to understand that VC tries to create value very fast in the companies they invest, right? They pursue the buy and sell approach, right? Actually, startup is just a product which is to be sold or exited. And these are the types of exits. Bankruptcy, it's a type of exit and very, very common. It might be an M&A. So the company is being merged or acquired by bigger players, or I don't know, companies in the industries which are very close to this one. It might be a secondary sale, so it's sale to another fund or to a trade sale, I don't know, other companies, other funds, or it might be an IPO. Of course, IPO provides the biggest outcomes in terms of money to founders and investors, but in terms of number, to the total number of exits, it is quite small. It became quite larger in the couple last years, but generally it's just a small piece. And the primary goal of VC is actually to maximize return, right? They seek several X, which is several times. Over 10 years investment position, usually they try to make it shorter. 10 years is the life of the fund, and during that life of the fund, actually we have to choose several investments and exit all of them. So in general, it's less than 10 years. However, theoretically, you can have a position for 10 years. And the risk should be acceptable. However, they understand that failure rates are high here. So the demanded returns, they only needed to pay back for those failures, which you will have most in your portfolio if you were the manager of venture capital fund. How they do that? VC invests in equity as of target companies. And usually those companies don't have tangible assets at the time of investments. They don't have stable cash flows, or even they don't have products. On early stage, for instance, it's only the idea and the team, yes. But in the industry, which you consider quite promising, the financing is done in stages, right? And usually it is syndicated to limit the risks. So in other words, you get the target, you find other venture investors, together you invest in the company. You need other investors because it validates your idea. So if you're the only investor in the company, that might be a bad idea. If there are no other investors who consider this idea interested from the risk reward standpoint, maybe you make a mistake. And you, of course, taking a bigger risk. And so it's always better to have a syndication. Usually there is a lead investor and other investors, and the financing again done in stage. So you provide the first chunk of the capital to the company for this company to get to some particular milestones. I don't know, to make the product, or to get first revenue, or I don't know, to get first clients in B2B segment, and etc. Then the valuation of the company goes up, and you provide additional capital, and etc. and etc. VC investors, they actually take an active role in monitoring and helping those companies to succeed. They're presented in board, they advise, they support, they help with recruitment, I don't know, they help the strategy, they help to find contracts to get the revenue, and etc. Usually founders and startuppers, they need that support. And that's one of the reasons why in venture investments, money, it's not all the company needs. Actually, given the amount of capital globally currently, it is becoming more and more important for the company to get not money, but this kind of support, this kind of expertise, and etc. And yes, it's very important here that financing totally or almost totally goes for the internal growth of the company. It's not used to pay out debt. It's not used to buy other companies. It goes into the growth of the companies, into the growth of the product, I don't know, into the development of new business lines. But it all should go into the expansion of the business idea as it is. So generally 80% goes in building infrastructure, which is needed for business growth or potential business growth. If it's not assets, if it's assets heavy company, so it's manufacturing, it also goes to sales. Sales everywhere is a drag in terms of cash flow. You need to sell your product somehow. There are a few products which sell themselves without sales force. And of course, you need to increase your balance sheet. So if you need fixed assets for your business to grow or working capital, of course, these also need to be financed. Okay, now let's switch to the characteristics of venture capital, to some of them. So today, again, it's an introduction lecture. I will try to give you small pieces of everything, so you get the first picture, and then we will go deeper in that. So what venture capital actually does, it alleviates this problem when there is an asymmetry between the uninformed investors and those entrepreneurs. Usually, if you are the founder, you know everything about the company, the potential business. And if you're an investor, you're actually uninformed, you have to believe. So venture investors, they have some expertise, they, let's say, knowledgeable to some extent to make such decisions. So actually they decrease this asymmetry by having this expertise. And it's important to know they fill this kind of void between the sources of funds for companies, innovative companies, right? Usually you get the traditional financing, which actually lower cost sources of capital, but they are being provided to going concern companies, established one, usually either on the growth or already on mature part of the S-curve. At the start, there are no banks which will provide you a loan to the cash flow negative company, right? If you're working, it doesn't matter where, in Russia or in other country, it's obvious. If you're a banker, you will provide a loan only to the company with positive cash flows. And most of the startups actually have a negative cash flows. So banking financing is not something actually available to them. Things are changing currently in difficult structures close to the growth part. Banks are starting providing the debt, and not only banks but venture investors, and this is the venture debt idea. But in general, in a classical situation, this kind of financing is unavailable. So, but capital is needed, right? And usually not bodies and friends and family, they don't have enough capital to provide to this startup. So there is a so-called, not a death valley, but there is a point in life cycle of the company where no capital is still available, but it is already needed. And this is the place where venture capitalists are. And that's the reason why they are actually the driving force behind these highly innovative people and businesses. They support those and help them grow new businesses and get money, of course, for venture investors who are actually only in intermediaries, because they usually invest other people's money. We'll touch upon that, but just remember that other people's money. And yes, very important thing to note is, last but not the least, the venture capital investments and venture universe itself, it's suited for a small set of opportunities. It's not a big industry even now. It's only $1 trillion of US dollars globally, and it's an all-time high now. You will see the numbers soon. It's really small, and big part of that number, it's actually not the money and not the valuation of the companies in the portfolios, but it's just the obligations of investors to fund the companies if venture funds will find opportunities. So that's again. So just to sum up, venture investors are important part of the business cycle of the company. They provide capital somewhere in the middle where other capital from other sources is unavailable, and still it's a small industry. And now let's switch to some important things about venture capitalists, as they are. They are financial intermediaries. Remember, there are a lot of financial intermediaries. Broker is financial intermediary, a bank is financial intermediary, and venture capitalists and private equity fund as well. They're also financial intermediary. They connect entrepreneurs with good ideas and investors looking for returns from those opportunities. But they're in the middle. They take other people's money. They invest in companies. If they're successful, they get money back to the investors with returns, and they made enough money for themselves. Yeah, they take that capital, invest into the companies, and actually they promise to return with a surplus, but most funds are actually unsuccessful. To be honest, there are interesting white papers, but in general, if you take out the biggest successful exits in venture industry, the rest of the industry has negative returns on aggregate for all investors. So you have to understand that it's not casino, of course, but it's not something which for sure provide you with positive return. Usually return will be negative on aggregate. But still, good venture capitalists, they're specialists in screening those high growth opportunities. In the last years, it's usually high tech sectors, asset light things, which is easily scalable. But it was not always like that. I read about the Starbucks story. It's just regular. I don't know. It's not. I would not. I would not say that Starbucks is a high technology company, right? And it has never been. But still, that's an idea of the startup and quite successful one. Again, venture industry is a small part of the economy. According to Boston Consulting Group, 2 years ago, it was only 0.6 trillion. Actually, according to McKinsey, as of the last year, it's less than 1 trillion. It's a small part of institutional investors' portfolio. However, it's quite important for economic growth in general, especially of the United States economic growth and Asia recently. And that's all together leads us to the final idea. That's actually, it's more art than science. And we will see why during our course. Okay, I see the chart. Okay, it will be very interesting to learn about venture debt topic. Okay, got it. If Maxim is not the only person who is interested in that, please let me know, and I will try to get some summary on that. At the first stage, some startups can generate negative cash flows. Usually, they generate always negative cash flows. How many years of it is appropriate in general? Actually, venture. It's interesting question, but venture has so large dispersion in the returns in the end among the funds and managers, and even more dispersion in the outcomes. So there is no general rule of thumb. So as far as you know, the companies already being public, which used to be large startups, unicorns. I don't know, take Uber, take Lyft, I don't know, take Tesla. But get out some subsidies from government to that, and they might have positive cash flows, but not so big. Take Amazon. That started to have positive cash flows somewhere in the point when it was public, but from the standpoint of view of net income, which is usually something where you pay dividends from, etc., it was negative for many years after the company became public. But Amazon is an interesting story. It's one of those business models when you have negative cash cycle. So actually, the faster you grow, the more cash you have, but it's cash of your counterparties, and you can play with that. You can invest that. You can put it in other startups and etc. But in general, the company which grows needs some money. And let's take Uber and some other companies which I mentioned. They are public and they are still having negative cash flows on a run rate basis, or I don't know, last 12 months basis. The market believes, of course, you will believe if you have a lot of capital around you, but the market believes that they will finally, I don't know, will get to the point when they will be one of the best, and etc. But I can't answer in general. I don't know. I think nobody knows. It always depends on the business model, on the company, on the region. on the cycle in the economy, on the innovation cycle, and many other things. But just keep in mind that until recently, a lot of companies became public after, I don't know, maybe 10 years of being a private company, a large startup, successful startup, but still having negative cash flows. They are very well capitalized, but this cash goes out. We'll see. We'll see. Okay, sure. You're welcome. Some other important characteristics. Venture funding is not the long-term money. They should exit in several years, and this is a must. Because, remember, it's other people's money, and those other people, they will ask for their money. They will give, if you're a venture manager and you have the fund, you attract money of investors, but you have to return them. And you better return them with positive returns. But it's not something that you can take for, I don't know, 20 years and say, okay, we'll see each other in 20 years. No, of course you have to return. And that's the underlying reason why the venture manager itself have to buy the company and sell it in several years. They, of course, should invest in private companies only. So venture capitalists do not invest in publicly traded securities. They might have publicly traded securities in the fund as a result of an exit, or not an exit, but a liquidity event, so-called. Let's say you was an investor, I don't know, in Uber. Okay, let it be Uber. I don't like the company, but still. You invested when it was private. The company went public. There was an IPO. You as a venture investor fund, venture capital fund, you have this company being priced every day now. You have to wait for at least maybe 6 months, so-called lockup period. And in the fund, you will have this situation when it fluctuates. But in general, you don't invest in public companies, of course. Yes, it plays a minor role in funding-based innovation and research. It's usually later on development stage and marketing. Of course, venture capital cannot replace other innovation funding sources. Again, due to the point number one, because the money should be returned in several years back, right? When innovations are being funded and supported, nobody knows when they provide some, I don't know, feedback or result. It's not something which might be expected with some kind of certainty. Yeah, but this is the very important role in the stage of innovation cycle. It's a period when the company commercializes its innovation. So this is the point when venture capital want to go into the business idea. Moment. And again, it's much more than money, right? Huge efforts from those venture capitalists are being done to increase the chances of those portfolio companies to survive. And again, because VCs, they are aligned. They need this company to succeed. Most of their companies will be even in bankruptcy, or they will not provide big enough returns. That's why they will try to help those promising ones so that they pay back the whole fund. Usually, successful funds are being paid back with only one successful investment, maybe two. Two, it's really unusual, but still. And here we come to this first notion of GPLP structure. Predominantly venture investments are being done through the venture capital firm, which is actually a manager. And the manager can manage a series of funds. Successful managers have like, I don't know, 15, 16, 20. So they more than 10 funds in their history when they raise money and return money with positive returns to investors. Of course, investors will be happy to join them with the next fund, and etc. And usually legally it's done through so-called limited partnership. In this partnership, there are LPs who are limited partners. They usually provide capital. And there is a GP who is general partner, but actually that's the manager who manages those money, who search for the investments, who made the investments, structure them, and then sell, and they return money back to limited partners. And there is so-called schedule, the normal schedule, 2%, 20% fee schedule, which means that 2% of so-called commitment, but okay, the size of the fund, 2% of the size of the fund is usually being paid every year to the general partner, to the manager, for just doing the regular job, finding opportunities, structure potential deals, and etc. And 20%, that's the so-called performance fee. It's the part of the profit after the cost being returned, which manager takes to himself, and he returns 80% to limited partners. So actually he gets part of the success. That's the successful thing. It's important to understand that venture industry is a well-established business, not a big one in terms when you compare that to other businesses, but it's very good business for venture capital firms, right? Because you have for sure 2% of your fund every year as a management fee. So you can pay your team, you can pay for rent, you can pay your legal and third-party legal, and etc. And if you are successful, you get additional performance fee. But it's important to know that the industry is still fragile and actually geographically concentrated. Of course, Silicon Valley is number one point, but here we have several hubs of venture industry. It's of course New York, also Boston as one of the places where the industry itself appeared. It's San Diego, it's London in Europe. The London is the biggest one. Interestingly enough, but it's Israel. And in the last 5 years, this market has grown significantly. There are many reasons to that, but one of the major ones is that the Israel is so small market that all the startups being started there, they initially target the global market. And that's why not the local one, like in Russia, for instance, or in Germany sometimes, but they initially, all the startups, they just target the global market. And then they are trying to find the ideas which will be accepted globally. So if idea is successful, the company is becoming successful very fast. It's Hong Kong and Asia and Singapore, Taiwan, Tokyo. These are the largest global places. And in those places, usually you have the concentration of both talent and capital. So actually, these are two things which should be together, because it's not enough to have only talent, because you need money. And it's not enough to have only money, because if you don't have enough talent, talented people, entrepreneurial people, you will don't have enough startups and opportunities. So it's, these two things should be combined together, and there are critical masses in each part of that. Otherwise, it doesn't work. And finally, together with angels, who are usually investing earlier than venture capitalists, and corporations who buy startups and actually growing internal venture funds, so venture capitalists, angels, and corporations are an important source of finance, and they're an important part of the ecosystem itself. Here, I tried to find some statistics for you just to get the flavor. It's the median net IRR to limited partners. So actually the IRR investors have received, but just keep in mind that's the database which has only part of the funds covered. And here you see that the buyout strategy is the biggest one. This is the largest circle, and it provided like not the highest one, but quite high IRR relative. But here you see that this is the venture capital without early stage, right? And as far as you see, for the funds started from 2004 to 2014, that was the least attractive in terms of IRR, and it had the highest risk. So the dispersion of that IRR was higher, and the median, not average, but median IRR was the lowest. It changes from year to year. So if you do it like now, for instance, that was as of 2018, as far as I remember. That's the picture I got yesterday. So that's for the funds. It's actually the window shifted 3 years to the right. It's from 2007 until 2017. So part of that funds already closed. Part of those are being closed, but part of that are quite young. So here we see in general that's private equity in general is a good strategy if you compare that with real estate or private debt or infrastructure investments. However, the risks are quite high still, right? And we're talking about private equity in general, not venture. If we go deeper and we'll try to split that, we'll see again so that early stage has the highest dispersion, so highest risk, right? It's still might be attractive, but this is just for you to get the flavor, right? So venture, it's fluid, it mixed, but risks are quite high, usually the highest among the sub strategies, and the returns are not always the largest. So in a nutshell, it's a quite risky thing. However promising. Remember, median it's something which splits the brightest half from the poorest half. But of course, in this successful part, you will have funds and managers who are providing the investors with much better returns. And everybody wants to go to that funds. And of course, most of the investors cannot. And that is another thing to note, that if you're an investor, and if you are not like from United States or China, let's say you're a local investor from here and you want to invest globally into the funds, not all the funds will be available to you. And usually the best funds will be unavailable. And if you go on your own, but if you go with somebody who is very respectful in the market, it's becoming easier. Okay, guys, so far so good. Need some feedback. What you will tell me? I don't know. Okay, thank you. And plus to Maxim, Alona, thank you. Okay, guys, any comments? When you are quiet, it's difficult for me to understand whether it's something you expect, or I don't know, should I be faster? Should I mention other things? Or you are fine now? Okay, let's then continue. Okay, I consider your silence as okay, but if I'm wrong, let me know. This is the comparison of the industry against the traditional asset classes. To be honest, it's an old picture. I haven't updated that, but I don't think it's quite needed, to be honest. You just increase that by 30%, everything, no problem. What's important here? The global venture capital industry is roughly equal to the capitalization of Russian equity market. So the global venture industry, global, it's more or less the same as Russian equity market. It's less than real estate investment trust with capitalization. So those of you who are familiar, I'm sure know that, but in general, that the types of securities being issued by the companies which actually operate real estate assets, usually producing returns. So it's not something very risky in terms of the assets themselves. It might be risky due to leverage and particular subsegments, but the idea is liquid real estate, liquid part, and it's a really small part of the global real estate market, is larger than the global venture industry. If you compare that to global equities and fixed income, again, the numbers changes, but just to get the flavor, it's many times less. So it's 50 times less. It might be 70 times less, etc. So from the standpoint of the investor, if you are a global investor, let's say you're a pension fund, or I don't know, the Norwegian fund, which collects a lot of money for the government of this country. The global venture industry is a small piece, and it cannot be a big part of your portfolio, of course. And that's the reason. This picture actually provides you the idea why this is the case. It might be a good booster. If you're a smaller investor, of course, venture capital might be a bigger part of your portfolio. But if you're big enough, I don't know, the pension fund or sovereign wealth fund, it still will be just a fraction of your portfolio. Okay, I see a lot of things in the chat. First part was interesting. Elizaveta, thanks. Does it mean that this another part which is not first is not? All is good, fine, okay. Okay, thanks. Thanks for feedback. So we continue then. This is the venture capital industry size as of by McKinsey as of the 2017. So the total assets under management for private capital markets, and you see the sub-strategies here at the bottom, right? So that was the venture capital, 0.6. And if you look in 1 year, it was more. If you look at it, the latest available, which I was able to find actually, it almost roughly $1 trillion. Okay, if they add growth here, it might be still okay, 1.5, right? But growth, we should know about growth, but usually most of that growth is not venture itself already. The terms of the deals, the terms of the funds, they are already becoming very much close to the buyout funds. So it's something in the middle, but still we can consider a growth strategy as the part which is to the most to the right of the venture spectrum. So early stage, middle stage, late stage, etc. This is some numbers. Yes, they already outdated, but not very much, to be honest. The amount of capital which goes into the venture deals according to the stages. So in terms of capital, of money, angel and seed financing is really, really small, right? Early stage VC is much more substantial, but the largest part of the money of capital goes on the later stage investments. Interestingly enough, of course, you have much less later stage investments in terms of number, and that's clear. So a lot of small investments are being made on the earlier stage. For the companies which succeeded, more money being invested on the middle stage, right? And in the early stage, I'm sorry. And then for more successful companies with the proven business models, when we have this growth on the S curve, more and more capital is coming into the business. So it's non-linear situation. And again, it's an S curve. Just always remember about this S curve. I found this quite interesting. And even to me, I'm trying to look after the market. However, this is the recent statistics, again by Prequin, Private Equity Intelligence, prequin.com. And you see the number of funds by strategy. It's not by capital, but it's number of funds. And look at the last 3 years. How, I don't know how to get the right word here, but the number of venture funds with venture capital strategy increased dramatically as far as you see. So it became very popular. We are not maybe in the dot-com bubble yet, but still just you see these numbers and you see these bars, right? So all of the funds with all the strategies increased, and that's clear. But if you look at the relative positioning and especially the absolute increase in numbers, so it's more than 4,000 funds being marketed at the start of this year, right? And it seems to be more than half of them pursue venture capital strategy, not buyout, which is the largest in terms of capital, right? And you see the growth, the one which is adjacent to this venture and adjacent to buyout, somewhere in the middle, has also increased dramatically, I would say. Just for you to get the idea, the alternative investment landscape is quite successful. The market is growing. It's growing across all the lines. And in hedge funds, actually, the situation is quite similar, not so much similar, but in the last maybe 1 or 2 years, the industry is becoming again very lucrative to investors. But in venture space, you especially see that drastically. Okay, guys, it seems to me that it's right the time we have to make a break. And actually, we have finished some basic things about the venture industry. I will touch upon the history of venture capitalism. I think it will be quite interesting for you to know. But as far as I get, we have to make a break. And I'm stopping here my presentation. And I will put that. How much time usually you have between two classes? Is it 10 or 15 minutes? Can you please remind me? Okay, chat. 10 minutes. Okay, 10 minutes. Okay, let's start at 10. So we'll see each other in 10 minutes and continue. Please take a break, maybe have some coffee, water. We'll see each other soon. Okay, we continue now. And the next block is the history of venture capitalism. So if we talk about the industry itself, I think it's quite interesting and important to know the roots of the industry. And it's interesting to see that those names most of us are familiar with actually have been a part of the something similar to venture investments in the past. So almost 1.5 centuries ago, John Davidson Rockefeller Sr. and his friends formed their own merchant house. They used their savings and borrowed some money. The company became going concern and was making positive P&L in 4 years already. They invested $4,000 at that time, together with Samuel Anders, that was a chemist, and the person developed a cost-effective method of distilling kerosene from crude oil. Remember this S-curve? That was the new market, cheap processing of the oil. And they established a company called Excelsior Oil Works and started commercializing this process. And that was the cheap and efficient means of lightening the houses, right? So they opened up the new market, and they was first on that, and it was a growing business. Interestingly enough, Rockefeller was smart, and he bought out the company of another person, of Clark, and he used money he borrowed upon his reputation. Reputation is very important in the venture industry. And they called the new refinery company Standard Works. That was establishment. Then the partnership with another person was dissolved, and the famously known Standard Oil Company appeared. And the company was controlling 10% of nation's petroleum refining business at that time. And later on, it became even more powerful, as far as you know. Famous Carnegie, Andrew Carnegie, at the end of 19th century, with his friend, again here, you see, not alone, usually with somebody, Henry Phipps. They formed Carnegie Steel Company, and they were driven by conviction that the status quo of the steel production will be changed. And actually, some say that laid the foundation of venture capital industry as we know it today. The company was sold in less than 10 years for $500 million. Just try to imagine the purchasing power of that capital at that time. And that was split 50-50 between Carnegie and Phipps. Remember, Carnegie was not like Rockefeller. They split it in the end. Interestingly enough, the Phipps, the second person, Henry, formed so-called Bessemer Trust. That was a private family office, and the aim was to manage his fortune. And Bessemer Ventures is one of the old standard names in the industry still. We can have a lot of details about that, but simply enough, Bessemer Ventures Partners was launched. That was the first venture capital firm. It currently manages several billion US dollars and has more than 100 successful IPOs and of course many more other exits. That's the website of the company. Again, Rockefeller, but it's another Rockefeller. So the senior John died. Lawrence Rockefeller, who was the grandson of the senior Rockefeller, together with other heirs, founded Rockefeller Brothers Fund. And they founded that as a limited partner investment firm. And that was one of the first pools of capital professionally managed. Rockefeller Brothers Funds changed its name to Venrock Associates in 1969. And that's the fund, the company's name. It was one of the most successful VC funds, and they were providing early stage financing for startups in Silicon Valley, including Apple, Intel. Currently, they make investments across the whole spectrum, from seed stage to private equity investments. And only recently, okay, 20 with something years ago, the company opened up for outside investors. Right? Before that, it was internally managed pool of capital, so family business actually. John Hake Jock Whitney, that was a rich American, and together with his friend, they founded the company Whitney and Company, and they were financing entrepreneurs who were returning back from World War II with the great ideas, which were not welcomed at traditional banks. Remember this, what I mentioned? Banks usually support businesses with positive cash flows, but a lot of people were coming from World War. They had interesting ideas. They saw other things across the globe. And the John Whitney Company was financing them. And the objective of the company was to provide this capital and professional assistance, not only money, remember, to those entrepreneurs, and to help them to grow the companies and reshape the industries. So disruption, okay, in other words. And some says that the term venture capital was a replacement for development capital, and Bernard Schmidt was the person who actually invented that slogan. Interesting example. Florida Foods Corporation. Those of you who visited the United States of America maybe have tried this orange juice. Very nice, I would say. I liked it. Interesting enough, that was the company funded the way we are discussing now. It was one of the earliest investments, and it was sold to Coca-Cola. And actually, another interesting example is the conversion of munitions plant, so making weapons, into fertilizer facility, expensive chemicals. All right, fertilizers are used in plants and agriculture. So today the company remains privately owned, and by its investment professionals, provide capital to equity from small to middle market companies with strong growth prospects. So usually it's focused on growth, right? Not the early venture, but still in many industries. And this is what this John was saying. We're here to invest in companies that we believe will succeed with both management tips and purposes, and etc., etc., etc. So we are proud, but in the end, we understand they were funding the promising early stage or middle stage companies and making a lot of money on that. And that was good times. Go further. Famously known George Doran, that he was a business professor at Harvard before the World War II, and together with US Senator and MIT president, they developed a financial vehicle that allowed private capital to participate in the war efforts through investments in the manufacture of weapons, equipment, and supplies. After the World War II, they launched the American Research Development Corporation, and that was the first actual venture firm which raised money from other institutional investors. Right? They raised roughly $2 million from 9 institutions, and that included MIT University, University of Pennsylvania, Rice University, and others. They also attracted money from mutual funds, insurance firms, and during the IPO. The company invested in 1957 $70,000 with MIT engineers, Kenneth Olson and Harold Anderson, to start the Digital Equipment Corporation, so-called DEC, and the company grew to roughly 36 million in 11 years, and they made an IPO in 2 years after that. Quite successful. And that success gave a huge boost to high-tech development along the Boston route. That's why the Boston became one of the hubs in the venture industry. This success actually demonstrated the viability of the venture capital investment model to others. And of course, when you have success, a lot of other people are going there, right? Currently, we can, I don't know, I can mention Bitcoin or cryptocurrencies where we have several people making huge money and a lot of other following them. It's just a herd psychology. American Research Development Corporation went public and collected additional chunk of money while going public. Another company, Greylock, but Bill Elfers, he was #2 employee in American Research Development Corporation. Together with Don Gregory, formed the Greylock and Company. That's the website of the company. And they formed that in the form of limited partnership in Cambridge, Massachusetts. The company raised $10 million from 6 limited partners. So that was already the working limited partnership. Then they launched the second fund. They moved the office to Silicon Valley at the end of the century. And head office also relocated to Silicon Valley. They opened and then relocated to that office in 10 years. Interestingly enough, the company raised the fund 13 with target size almost 0.6 billion. They increased that to 1 billion due to oversubscription. That was 10 years ago. The company invested in many companies you already know. They actually defined several new markets. They invested in Airbnb, AppDynamics, Cloudera, Dropbox, Facebook, LinkedIn, Palo Alto Networks, and etc. 4.5 years ago, they raised 15th fund, again 1 billion size, and they closed that in just 3 months. When we say close, it means that no more new investors are being accepted. Usually, for you just to compare, it takes 10-15 months to close normal fund. So roughly a year or maybe more. So if somebody is closing a big fund in just 3 months, it means the huge demand from the investors. And today the company managed, again, several billion US dollars. They had more than 100 profitable M&A deals, close to 200 IPOs since the establishment. That was interesting examples for you just to know several early names in the history. Of course, today we have many more. The most famous, currently most active and most successful are recently Sequoia and Benchmark. But if we go back to the history, it's important to understand several aspects in the global politics and economics, which actually boosted the venture industry. As you remember, or you maybe know, USSR launched Sputnik and started the space race with the United States in 1957. United States responded with funding defense, which was related to research, and new regulation was invented. And it was aimed on easing access to capital for small businesses. They did it in just 1 year. They passed the Small Business Act, they established the Small Business Administration, and they allowed to create small business investment companies, so-called SBICs. Small Business Act actually addressed that major gap which existed in capital markets. Remember, USSR was an economy of plan, United States was the free market economy. And there was a gap which existed in capital markets for long-term funding of growth-oriented small businesses. More to that, this act allowed the banks to circumvent so-called the Glass-Steagall Act's prohibition on ownership of stakes of more than 5% in industrial companies. This regulation fostered entrepreneurship companies and actually spurred technological advances to compete against the Soviet Union. So what was done? They allowed the venture capital firms to access the federal funds, and they provide actual leverage at the ratio 2-to-1 against privately raised investments. So you have to raise $1 and you will get $2 from the government. So you'll have $3 together, and you could invest that in long-term growth opportunities to compete with Soviet Union and in space. Of course, this allowed some people to accumulate capital quite fast, professionalize the investment activity processes, and establish venture capital firms. Right, that was the result. And actually, in 1960s, the development of limited partnerships for venture capital and, of course, private equity investments appeared. So limited partners were the actually those who provide the capital and pay management fees, right? So actually pay for expenses. General partners are managers. They manage capital, they invest in companies. And successful investments are, when exited, they split the distributions among the partners in proportions 80 to 20 after returning the original investment to limited partners. So actually it's so-called profit sharing or carried interest, or you might hear like performance compensation. But the idea is the following: you get some capital from investors, you return this cost, and if you have something extra on that, you split that 80 to 20. So 4-1, right? Interestingly enough, but even after that, the fundraising in the industry was small enough, despite those Small Business Investment Companies Act legislation. It was less than 1 billion investments per year. So just for you to understand, it was less than, it was a small fraction still, but there was a defining moment. In 1978, the Revenue Act decreases the capital gain tax from roughly 50 to 28. Remember, this is the this is the tax bracket which Biden currently wants to take taxes back from 21, which was done by Trump. In 1 year, relaxation of investment rules was done for United States pension funds. And actually, Employee Retirement Income Security Act, ERISA so-called, it allowed investing up to 1/10 of the assets into venture capital industry. And Department of Labor implied that investing small fraction into venture capital was not considered imprudent. Remember, there is a huge regulation in pension industry in the States, but it was relaxed. And later on, capital gain tax was even further reduced to only 10%. And this was the defining moment. Huge inflows went to private equity and venture capital from pension funds, and of course, other institutional investors, smaller but still smart, like foundations, endowments, and family offices, they followed. And this is when the huge inflows started to go into the industry. So, in the nutshell, it's only 40 years of the actual industry as it is, as we know, when it was started, right? In terms of size and capital. It is still growing, but it is still small in comparison with the total size of the economies and other asset classes. Okay, that was the short history. And now another short piece of history, the official history of Silicon Valley. It all starts with so-called Tractarius 8. There was 8 people who are said to form the Silicon Valley as we know it. It all started with William Bradford Shockley Jr. He was an American physicist, and he co-invented the transistor along with other people. All of those named before were awarded with Nobel Prize in physics. This person, William, he convinced that natural characteristics of silicon meant that actually silicon will eventually replace germanium as a primary material for transistor constructions. So actually the William just changed the technology, right? And he opened a Shockley Semiconductor Laboratory that was a division of Beckman Instruments, and it opened that in San Antonio, in California. Sorry, Mountain View. In 1 year, his team of 80 untalented engineers left him. He was told to be very, very badly treating people, and they decided to go on their own. They all left, and they left from. They formed their own semiconductor company. They called that Fairchild Semiconductor. Again in Mountain View, just next to him. The company was funded with $1.5 million of a loan from another company, and a person, Arthur Rock, was there. It was like a middleman who actually made this all working together. He was an early venture capitalist, actually from New York. This company, Fairchild Camera and Instruments, became the first venture fund startup in the Bay Area. The company made transistors out of silicon instead of germanium. That's where the term silicon before valley comes. Interestingly enough, each of those 8 people, 8 tutorials, received 10% compensation via participation in equity stake. And Arthur Rock, who just put it all together, received 20% of this newly formed company. And some say that that was maybe the original famously known today financial motivation scheme of 80% to investors and 20% of success fee. Who knows? Maybe yes. But at least numbers get together. And interestingly enough, people, of course, start leaving the company with time. One of them left in 1969. He co-founded Xicor company in 9 years, sold it to Intersil Corporation for $500 million in 2004. So actually, he was many years with that company, right, as a founder. There were other people who actually left the company and started successful businesses. Victor Henry left Fairchild. He studied computer science. Interestingly enough, he invented this so-called radio frequency identification systems. Like this is something we currently see when the people are scanning the codes on the boxes. But at that time, it was the new technology, and he commercialized that. John Amedy Horney, he developed a planar process for manufacturing semiconductor devices. So actually, the way the transition is being done, co-founded another company, again with Arthur Rock, then another company. So he was more like a senior entrepreneur. He founded that Intersil company, which was co-founded with another. And so that was a small society, and they already started to fluid with each other, trying to get together some ideas, and etc. One of them was Eugene Kleiner. He led actually those other 7 to the newly formed Fairchild. So that was one of the tutorials 8. He invested his own money in Intel. Co-founders was Robert Noyce and Gordon Moore. Of course, you heard about Moore law. They together also with Hewlett Packard veteran Tom Perkins founded a company called Kleiner Perkins. That was a venture capital firm headquartered in Sand Hill Road in San Francisco. And they made early investments in more than thousands of IT and biotech firms, including Amazon, IO, Electronic Arts, Google, Sun Microsystems, and many others. JT Last was a physicist. He left the Fairchild among the first, co-founded Amelco Corporation. I remember that the name was already before that. But then he founded the Archaeological Conservancy and just switched his focus from startups and technology to preserving and protecting archaeological sites in the States. Sidney Sheldon was responsible for silicon crystal production in this newly formed Fairchild. They, together with Gene Horney and Jay Last, found Amelco. This is the Dr. Gordon Moore. That's the chairman of Silicon Valley. He's the author of Moore's Law, which says that the number of transistors on integrated circuit boards and thus computer power will be doubling every 2 years. That was more or less the same, actually corrected prediction. He left Fairchild, the company where they all 8 went together. He co-founded another company, NM Electronics, with Robert Norton. And again, Arthur Rock was here. So that was a quite interesting person for sure. The company changed its name to Intel Corporation in 1969. This is Robert Norton Noyce. He was supposed and named as a mayor of Silicon Valley, and he is credited with the invention of integrated circuit or microchip. We use it everywhere now. Together with Gordon Moore, co-founded NM Electronics, which then became Intel. And he said to treat employees as a family, and he was a proponent of follow your bliss management style. which was not very much corporational army styles at that moment. And in terms of history, that's it. I hope it was interesting. At least to me, it was interesting to put it all together. This is some statistics and numbers. So the number of venture capital firms in existence, it was increasing. Remember, the market is growing. Number of venture funds in existence increases through time. The number of first-time venture capital funds raised was also increasing, but as far as you see, it's a small fraction. So actually, the huge majority of the funds are being established and opened and run by the proficient managers already, right? It's not that easy to be the first comer to the industry. However, some are trying, and as far as we know, at least Benchmark Capital is a really good example that this is all possible. In just a couple of decades, they made a really great company. Venture capital assets under management, that's only for United States. In 2018, it was slightly above 200 billion. I'm sorry, 400 billion. If you look at the average numbers of statistics, it seems that on average, each firm manages a quarter of the billion, and almost the same number is the average size of the fund. And when we say about the size of the fund, remember, it's not only the money already invested, it's the money which can be invested, but are not provided by limited partners yet. And some other numbers also can be found here. And at the bottom, you see the largest venture capital fund raised to date. So if the average fund is a quarter of a billion, still the biggest one, at least 2.5 years ago, was $8 billion US. But of course, that was for sure not for early stage investments, but for late stage growth investments, mostly. Okay. Now let's move to so-called waves of innovation in history. Remember, this is the way the technologies and the companies evolve. So the product performance increases fastly somewhere in the middle, and then it stops, and the business and the industry becomes mature. So at the start, that was Shockley Semiconductor. Then they left that. They formed the Fairchild Semiconductor, then the National Semiconductor, then Intel, AMD, and etc. So that was the sweet spot for those companies making those chips and circuits. And then the industry appeared as we know it already. But of course, the next wave came and was Hewlett Packard, IBM, Xerox. That was another types of companies. Apple appeared, as far as we know, of course, Sun, and that was the age of computers becoming more and more convenient and more widespread among the people. So as far as you see, the technology has one S-curve. When it stops, another S-curve appears, and this is when the venture capitalists are switching from one industry to another, right? And then we've had another wave. That was the Cisco, that was eBay, Yahoo, and development of those social networks, search engines, and etc. So it's one wave, second, and as far as I understand, it's not only about technology, it's biotechnology, it's nanotechnology, and many other types and aspects of technology. So in general, if we look at this, at industries being born and appearing, we should keep in mind that all of them follow more or less the same pattern, right? So it starts somewhere, it's barely seen, but then there is a spike. It's somewhere at the spike here. Angels and early stage investments are coming, and then it's becoming more interested, more and more capital following, and we have a huge increase in number of companies following the particular industry or products or technology. And then we have a lot of competition, and the industry matures, and then you should switch to another industry. and etc. Yeah, recently actually clean tech has become not the mainstream, but one of the important aspects, and concerning the ESG and SDG abbreviations, I think it might be a quite interesting opportunity, but it's already not asset light, maybe not asset heavy, but still it will require more capital. It's not a software only. I found this interesting picture. It's not very good. The resolution is not very good, but still we can look at the venture industry as in pieces like here. So the first wave was like still connected with defense and Cold War. Then integrated circuit were invented. Then after that, of course, personal computers have appeared. That was the third wave, right? And Cold War defense cuts appeared, and then there was money and capital and talent moved to the to other industries, not somehow connected with war or competition among USSR and the States. Then we had a fourth wave, which was an internet bubble, which bursted them. And then there was a fifth wave of social media. I think currently we have a sixth wave, but it's difficult to name particularly one industry here. It seems like there are already many important sub-industries and S-curves we're witnessing today. Okay, now I think the question of where ideas come from appears, right? And let's look at that. Can you tell me your thinking on where good ideas come from, looking at these two pictures? Actually, this picture of two circles. Any ideas? Where are good ideas coming from? Okay, let's move on. As far as we know, the bad ideas are cheap, right? Obviously, bad idea is cheap. Nobody wants them. Okay, I see something in the chat. Part of bad idea. Maybe, yeah. Obviously, good ideas are expensive, right? As far as you know, to get the huge return, you have to buy cheap and sell expensive. So the easiest way is to buy cheap bad ideas and sell expensive as good ideas, right? But actually, there are ideas that seem to be bad initially, but actually they are good. It's not so obvious. It takes time, effort, and maybe lenses, but in the mind of people. But these are the best investments, actually. So ideas initially seeming crazy or bad, but in the end becoming good, these are something which strikes a lot. And there is so-called Gartner hype cycle. So usually the idea is not interesting. Then there is a huge spike of interest and visibility. There is a peak of so-called inflation expectations. Then there is a disillusionment, and a lot of investors, shortcomers, they leave in the industry. And then finally we have a plateau of productivity. And this is where the industry is becoming mature. So the S curve is somewhere in the first part of this graph, but just for you to get the flavor, right? It's something not interesting, then becoming good, a lot of interest, it goes down because it's not so good as was expected, and then finally we have some plateau. If we look at the United States R&D spending, we'll see that throughout the half of the century, even more, the total expenditure on R&D was in dollars was growing almost without stopping for substantial period of time. If we look at that in terms of GDP, it was roughly slightly below 3%. So it seems to be that spending couple 2-3% on R&D was like in the DNA of the United States of the company and venture industry of that. But interestingly enough to see here, at the start that was the federally funded. Remember the history? Initially that was the government which were providing 2-to-1 ratio funding. But then professional VC investors appeared, government pulled back, and private investors came, and pension funds came. And they are not considered to be government. And it was mostly funded by private capital. If you look at the share of total global R&D spending in R&D magazine, you will see that it's more than a quarter. 5 years ago, more than a quarter, it was in the North America, mostly United States, and it was 42% in Asia, and half of that only in China. And you see also Europe, but interestingly enough, that in Russia CIS, you still can see this part, but it's still 10-20 times less. And of course, the efficiency of this spending is also a question. And it's no wonder that actually North America and Asia, particularly China, are the main hubs of venture capital currently. Because maybe not because, but there is an interesting consequence, right? These are two regions with the largest and lion's share of R&D spending globally, and these are the two biggest markets. If you look at the US R&D performance, you will see that on development, most of the capital is spent on this stage. So it's not basic research, it's not applied research, but on development. So actually, what is important here is the true innovation comes from R&D, but it's not where the venture capitalists are. Lion's share of R&D budget spent on development, it's on the stage when product might be born or the technology might be born. In this stage, angels and venture capitalists join the train, right? But it all doesn't work without basic and applied research, and it's not funded by venture industry. So this should be another source of funding. So if you look at the global R&D spending, you see again here that States and China are the biggest circles. However, if you look at the color, you will see that Asia, in terms of capital spend, it's quite substantial, as well as Europe. And look at the Israel. It's quite substantial. It's a small circle, but in terms of, as far as I remember, it's GDP, part of GDP, it's close to 4% at the below. And Israel is one of the hubs currently. It's not big market, but it's the source of many successful global companies. Somewhere which actually targets some bottlenecks across the global technology chain. Okay, maybe some questions at this point. So far, so good. Move on. Okay. Now let's go deeper in and see how venture capital works. This is the basic picture. It's actually from the book I recommended. So it's a circle. It's a venture capital circle. I'm sorry. Venture funds, which managed by general partners, GPs, are collecting capital from limited partners or investors. They put that into portfolio companies, which then successfully exited or unsuccessfully exited. And after that, the GP is attracting another chunk of limited partners, usually for a newly opened fund. And then the situation continues. So every 3, 4, maybe 5 years, currently maybe 3, 4, the manager opens up a new fund. And here we have to mention pension funds, foundations, endowments, and family offices as a substantial part of the capital being deployed in the industry. Of course, the industry, to be honest, is becoming more open for retail investors, not small retail, but high net and ultra high net individuals, mostly through banks. But it seems to me that in the coming couple of 2-3 years, we will see interesting products being marketed to high net worth individuals in the space, maybe even lower price point bracket. But the industry is growing and is trying to accept more and more capital from a wider audience. That's for sure. In a nutshell, venture capital attracts funds. It takes maybe usually 1, sometimes 2 years, and you devote from 10 to 100 meetings with investors to secure that funding. After that, when the fund is closed, the money are being invested throughout 3 to 5 years, and as far as you get, the money are not provided initially 100%. They are being called in pieces on an as-needed basis. The manager, during that period, which is called investment period, screens thousands of proposals, makes thousands of calls, dozens of meetings, and maybe after that, he will have 1 to 3 investments. So actually, you have to multiply it by the number of investments in the portfolio, which is usually 10 to 15. It might be slightly less, sometimes more, but on average, you can consider 10, 15 investments in the portfolio. So basically, it means maybe 3 investments per year, 3, 4. After that, after investments are being done, the manager monitors and develops the portfolio, and it takes another 3 to 5 years, and then exits should be done. Remember, that's other people's money, which should be returned back, most probably with returns on aggregate basis, but many companies will fail for sure. If you look at this in a nice picture, it will be looking like that. So fundraising, then investment, in the best case situation, the growth of the company, then its exit and money being returned or reinvested. And that's maybe it from the basic structure. And now let's touch upon the venture capital, the logic of the deal. In a nutshell, in aggregate, we will dive deeper later on. But at the moment, first of all, the downside protection. Because many investments will fail, the venture investor wants to be secured as much as possible against potential downsides. And given that the company will most probably require additional rounds of financing, it all appeared in different parts of the deal structure. But first of all, investments in the States, for sure, are being done in preferred equity securities. There are also so-called liquidation preferences, which puts the latest investments at, it's like LIFO structure, like last in, first out, which means that if you are the last investor, you are the first one who is getting out of your money. So the earlier investor you are, the less protected you are. You should understand that. And there are also ratchet against so-called equity dilution. It works the following way. If you invested in the company and the next round is a down round with lower valuation, it means that you might be easily diluted. So you, I don't know, 25-30% equity stake will become 3% equity stake. And you have some legal instrument against that. However, they works not always, but at least from time to time they might help. Also, venture capital want to get the favorable position for additional investments if the company proves to be a winner or just successful. So in a situation when the company will need money and venture manager sees that the company might be quite successful, so the chances of success are increasing. With the chances of success increasing, venture investor wants to put more money because the risk is going down. It's clear. And he wants to be in the favorable position. So he wants to be the first one the company will be asking money from. And in the situation when more money is needed, then the new round will be opened. In a typical deal, venture capital firm would invest 1 to 5 million. The numbers actually increased in the couple of last years, but let's just revert back to the normal situation. So the 1/3 preferred equity ownership for, I don't know, several million US dollars on early stage investment is a normal situation. When I say VC firm here, let's remember that usually it's several firms, to be honest, right? It's a lead investor with several other investors, but we will be speaking in single form here. Also, venture capitalists want to have some blocking rights on particular decisions by management, given that his position is still minority, right? And they also want to have disproportionate voting rights. So on particular reserve matters, they want to have an increased voice. And from time to time, co-investments were being done with other VC firms. So remember, lead investors and followers. Digest. Okay, then staged approach or tranches. What important to get here? So first investments being done, that was stage investments. It is the money being provided for the development and for particular milestones. If the company fails to meet the milestone, then the valuation reset is being happening all the company closes. But the idea is simple. You provide money for particular goals. The company tries to get to that milestones. If it's successful or more or less successful, next tranche of capital is being provided, usually in the next round of financing with some new investors coming in. But if the company or management team are unsuccessful or the product is bad, market doesn't accept that, many reasons might be. Somewhere in the middle, the company stopped being financed and become bankrupt. It's important to know that actually it's a free optionality for investors here. So the idea to think about that is you want to put, I don't know, 10 million US dollars in particular company, but you will be doing it in stages by 2-3 millions, because it will help you save the remaining part of the capital in case the business idea be unsuccessful. If the idea is successful, you'll be putting additional money into the company. Yes, your fraction on each stage will be smaller and smaller because the valuation will be higher, but the risks will be lower as well. So in aggregate, your expected probability of success will be higher. So that's the basic idea after the venture financing. And this is the ideal situation. You want to put $2 at the entrance and get a lot of dollars at the exit. This is what every venture manager pursues. That's their dreams. And not only that, because that's the dream of investors. But here you can find some numbers, and that's a return of calculations. So to get more than, I don't know, 35 or 35%, you have to, in 4 years, you have to do, if you want to have 4x in 4 years, your IRR should be 41%, right? So if you in 4 years you want to get out 5 times of your cost, it should be 50 IRR %. So the numbers here, which are not yellow, that are very good investment returns on the level of particular single investment. It's difficult to get them, to be honest, right? We will see statistics later on in our lectures, but to get more than 2x or 3x is an exceptional situation on particular investment. And given that most of your investment will be below that, to get the significant return on the aggregate level of the fund and get some success fee, it's not an easy task. So again, this table is just for you to get the flavor. How mathematically you can get substantial return. Not that easy. And of course, you have to subtract additional fees on different levels, lawyers, deal expenses, and etc. from that. If we look at the global industry from the pitch book, it's another database. At the bottom, you have the years, which is the vintage year. Vintage year means the year when the fund has started. Remember, the fund starts at vintage year, and usually the length for the term of the fund is 10 years. Sometimes it might be extended for a couple of years. So the fund started in 2013. As of mid-2016, the industry was shown the following IRR metrics on the fund level. So the top quartile, 25% of the best funds, which are in the database, was showing roughly 15% IRR. But the top 10% decile on aggregate was shown close to 40% IRR. Of course, it all depends on whether the IRRs are realized or unrealized. But still, for you just to get the flavor that even top 25% on aggregate, on average, are not showing great returns. And keep in mind that most of the funds are not in the database. So every year, maybe 300, 400, 500 new funds being launched. If we look at the database in the databases with, I don't know, maybe in 3-4 years time or 5 years time, we will see that of those several hundred funds, only several dozens are in the database. So the visibility of the industry is quite low. And even of those who provided information about themselves, or the database get this information from somewhere else, let's say from pension funds, which are obliged to open the information, they still see that the returns are not that great always, right? So for you, just again, remember that Preqin statistics on risks and return, the industry is very risky. The best managers will provide you good returns, but to get to that managers is really difficult, and they are not always consistent, and that's okay. That's just the nature of the industry. For you, just a small homework: try to find out the venture capital bottom quartile and decile performance. Just go at PitchBook or Preqin, or I don't know, there are other databases. Just freely search in Google, spend maybe 10 minutes for yourself, just self-educate yourself. Okay, this is the breakdown of venture capital portfolio performance. The simple example from the white paper I will send you from Harvard Business School. So let's suppose you invested $200 in a bad company. The gross return is 0, so net return is minus cost. The company which returned you a cost in 5 years, it's 1x. Your net return is 0. So maybe there was another company which returned you 5x, and etc. etc. So totally, that would be your situation. So out of 5 companies, only one will, if only one will lose, you will get 4x on your fund, right? And that's the very rare situation, almost impossible. Sorry, I'm reading the chat from time to time. Don't very fast growth, especially on first goals, scare investors because company can buy back itself. Konstantin, I didn't get the particular answer, but I will try to guess. So you are most probably asking whether investors are afraid of companies with really huge growth numbers. I don't think they afraid. I would say vice versa. It's really good if the company is hugely growing. The valuation will be growing as well, maybe even faster. And there is a secondary market already. So usually, if you want to get some, if you want to get out partially of the company, you can sell part of your position on the next round to the new investors, and you can monetize part of your success. The company will not buy back itself usually because it needs money for growth. And there is no sense of buying back investors because it's another stage of the business. So usually investors are being bought back in mature companies when other investors want to increase their share, or I don't know, usually buybacks are being launched by public companies. Everything is possible, of course, different situation might appear. But if the idea, is it a problem? No, it's not. Huge growth, it's good, it's not bad. So this is actually something investors and managers are looking for. Particularly in your question, most probably this company will be a fund paybacker. So just one company will pay back the whole cost of the other, I don't know, 10, 15 companies. So this company, the exit, successful and timely exit from such company most probably will provide a huge return, which will cover the costs and failures of many others. But no, you as investors should love high growth rather vice versa. Okay, and for you just to get the flavor again, this is also statistics, and maybe yes, it's not outdated, but still, you see that as of the mid of 2016, if you look at the, I don't know, funds launched in 2009, 2010, and that's the median that's in the middle, right? You see that the total multiples was roughly 1.5. So it's 1.5x in 6 years, I would say. So a median fund is 1.6 of its cost. So if you investors invested $100 million, the valuation of the portfolio would be 1.6, including the money distributed. So if you look at, let's say, 2010, which is roughly 1.5, 1.48, it says you that the net asset value of the fund is 1.07, and 0.35 have already been returned. In terms of US dollars, it means that on every $1 invested, you receive back 35 cents already, and $1.07 are still on the fund unrealized. Recently, these numbers went up, picked up due to valuations, but not very much significantly. So to get the numbers from the industry say us that having multiples of 2x and more is quite rare. It's really good funds. And remember this table, 2x is just the first column. So to get extraordinary positive returns in the industry is a huge, difficult task. Okay, here are the picture which actually shows more or less the time spent by fund managers on different activities. So maybe 10% they spent on soliciting businesses, like by 5% on selecting opportunities, analyzing business plans, negotiating those investments. But then after the investments are done, as far as we see, most of the time are being spent as a directors or just as a process of monitoring the investments done. They act as consultant to those companies. They also help recruit management and assist on outside relationships for their companies, and 5% spent on exiting. That's from the paper of Harvard Business, which is quite old, but more or less it gives you the flavor that actual job of the manager, it's not mostly searching for opportunities and making investments, right? It's mostly, this is very, very important part, but it's not the biggest one. After investments, the largest part of the job is being done after investments, right? After you put money into the ground, you have to monitor, you have to help the companies, you have to consult the company, you have to help with management. I don't know, help the companies to find a relationship, scale them business, and in the end, exiting. So still, it's not only about looking for models, reading nice papers and saying, yeah, that business should be nice, and just buy it, and that's it. No. Here, for you the statistics to get the understanding, to feel the flavor of why to get the successful investment is difficult. Let's suppose your company has the probability, you have high probabilities of every important aspect of the business. So company has already sufficient capital, most probably yes. Management is capable, focused, really good, yes. The product is being developed nicely. No problems with production, component sourcing, right? Competition is low. Customers like your product, most probably. Pricing is okay. You're fine with pricing. No big mistakes here. And the IP rights are protected, more or less. And still, if you combine that, you have only 1/6 probability of success. Try to imagine the probability of success of the company with lower probability of particular pillar. It's much lower. And that's, again, the reason why successful investment in venture industry is low in terms of probability. Okay, guys, so far so good. Actually, we have almost finished. Questions, maybe discussion, or I don't know, just let me know. I should open the chat. As far as I get, that's the most convenient way for you to communicate. I will wait a minute, and if not, we will continue. Thanks, Victor. Okay, now let's slightly touch upon the limited partnership structure. This is how funds are being structured. So there is the venture capital fund itself in the middle, which is called limited partnership. In this partnership, several limited partners are invested and they have ownership in the fund, but legally correctly would be say interests in the fund. So given that it's partnership, you have the interest in the partnership. And there is a general partner, which is a venture capital firm, and it manages the fund, and it also has small ownership in the fund. Usually it's called GP co-investment or GP share. So the manager should have some skin in the game, right? Because it's other people's money. But if manager have nothing to lose, then the motivation can be quite, I would say, not aligned very much with other investors. So usually the manager puts 0.5, 1%, sometimes slightly more, but on average maybe 1% into the fund. So actually, out of 100%, 1% is being owned by fund manager, and this is his risk, and other 99% are being owned by limited partners, proportionately to the capital commitments. We will touch upon that capital commitment. Commitment is a legal obligation to provide capital to the fund in terms of cash wire transfer when fund manager will ask for that, and you are legally obliged. If you don't do that, you have problems, big problems. And the fund then looks for investments and invests in investment companies. The manager does the whole job. Once he had found the company to invest in, he asks for money from limited partners and put the money in the ground. Okay, here we have to touch upon important words, which we'll cover next time. But first of all, limited partner, general partner framework, which I just have shown you. It's commitment. The easiest way to compare is in traditional assets. When you buy a stock, you put 100% of capital up front, right? You have the DVP, delivery versus payment settlement. It might take a couple of days, but more or less you pay 100% money at the start. Same with mutual funds and even hedge funds. In hedge funds, you have to put 100 capital upfront. You are fully invested from day one. That's very much important. In venture fund, as well as private equity fund or any private capital fund, you never fully invest. So when you have a capital commitment of 100 million US dollars, it means that you most probably will be asked for maybe 10, 15 million US dollars in year one, and more or less the same amounts every year in the next 5 years. And maybe starting from year 3 or 4, in good situation, you will start receiving some money back already. So you investing at the start, you start receiving money. So on a net basis, you are never invested 100 million US dollars. So your actual exposure to the asset class usually is lower than the commitment which you made. But this is a legal commitment. And the capital calls or drawdown notice or takedown notice, that's the legal documents or legal term used to describe the situation when the manager legally asks for money. Usually the manager can ask for money only to the amount of total capital commitment made by the limited partner, the investor. But once the manager asks that money, you have usually 10 business days to do that. And if you haven't done that, you have problems. You might lose your interest into the fund. You might not be accepted for newly done investments. You might be cheaply bought out by other investors, and of course, you will have problems with next funds. So manager will not accept, most probably, you as an investor in his next fund, because for him it's a problem. He needs capital in several weeks or days to close the deal, and one of the investors cannot provide the money. You cannot close the deal. You have to find somewhere money very fastly, and it takes resources, amount of time. It provides stress into the deal and process. So it's something that everybody wants to avoid. Investment period, and sometimes it's called commitment period, usually in fund of fund structures. But this is the period when manager can ask money for new investments. So consider a situation when you have 100 million US dollars commitment, and the investor asks for 15 million. Next year he asks for 20 million, and then investment period stops. Usually manager cannot ask money for new investments after the investment period has finished. He can, though, ask money for follow-on investments, so for investment in those companies which are already in the portfolio. Remember, usually you do it in steps. And that might be a situation when he will ask money for follow-on investments, or of course the manager will ask money if he already committed to the company. So let's say he signed a paper that I will provide you in 3 tranches every year by 5 million. And even after the investment period has finished, the manager legally can ask investors to take that money after the investment period, because that was initially committed. So actually the obligation was already formed below. New and follow-on investments. The management agreement is the document which actually frames the work between the manager and the fund. So according to that agreement, the manager receives management fee, usually that flat fee of 2%, 2.25, sometimes 2.5 every year, and 2.5% out of commitment. That's another important point. We will touch later with details on that. But remember, you have obliged as investor for a commitment. You have not paid your money yet. Investments have not been done yet. But the manager will already ask you to pay 2% on top here, sometimes on top, to just fund his salary and the rent expenses as a team, investment team. The document where you can find all those nuances is so-called partnership agreement, a limited partnership agreement. Usually this is the major document where everything is being described in details. There is a management agreement, separate one, but for you as an investor in the partnership, the most important document, number 1, is LPA. Remember, investments can be realized and unrealized. All right, and the best investment is a realized investment with positive returns. Carried interest is the name of another name of successful fee or performance fee. So actually, that's the part of the profit which manager takes with himself. In funds like venture fund and of course in private equity, they might be so-called preferred return or hurdle rate. Usually it used to be 8%. In different strategies it differs, but this is the IRR which should be made for limited partners, for investments, before any calculations can be done for carried interest and manager can take anything out of profit. For early stage investments, for early stage venture funds, it's not common. Usually there is no hurdle rate. So if the total fund is 100 million, in the end it's 150 million, so it's 50 million surplus. The manager takes 10 million and 40 goes to investors. So in the end, 150 is being split like 10 and 140. If it's a growth investment, so closer to that private equity stuff, or if it's a private equity strategy, as an example, usually there is a hurdle rate. So usually all cash flows for investors are being taken according to limited partnership. You have to carefully read that because it might be quite tricky, not in your favor sometimes. But the idea is the following: all cash flows are being taken. IRR for investor is being calculated. If it's below the hurdle rate, let's say 8%, everything goes to the investor. Manager gets nothing until the moment when the IRR is higher. Then investor should spend some of his profit with manager, and manager starts receiving his performance fee. So manager is motivated to make more than 8, maybe 10% IRR on cash flows, which is okay, right? Because otherwise, what's the sense of making, I don't know, 7% IRR? You can sometimes get that on high yield bonds on emerging markets in terms of stress. There are so-called catch-up provisions. So catch-up is being turned on when 8% hurdle is already reached and there is additional profit. So then every next dollar goes to manager until some point in time in the moment, and only after that it's being split. But there is a clawback provision in the United States. It's a common practice that the fund is the manager is paid success fee or carried interest not in the end but after each deal. It's very GP friendly, it's not LP friendly, but there might be a situation when somewhere after the carried interest has been paid to manager, the IRR to limited partner goes below 8. Let's say promising investor become bankrupt, right? On aggregate level, the return for investor will go down or below hurdle rate, and it's a situation when the manager has to take his performance, give his performance fee back to the limited partners, to investors. But there's a tricky thing here. It's usually net of tax. So if manager paid taxes from his performance fee, he cannot get these taxes back from tax authorities and give it back to limited partner. So in the end, limited partners will get only part, most, but not all. So something like that. And shortly for prerequisites for venture capital industry, remember, availability of investment capital is important to provide sufficient large returns to justify risks, right? So, and there should be sufficient supply of opportunities. So it should be both on supply and demand side. There should be enough venture capitalists and entrepreneurs as well in the ecosystem to support this supply, and they should be willing to take this kind of risks. Venture capital, financial risk, entrepreneurs, personal risk, life risk, career risk, and etc. The legal system should be quite friendly to problematic situations, right? Given that in the industry there are a lot of bankruptcies, failures, and etc., the legal system is very important, and it should protect investors. to some important high level degree. Currency convertibility is quite important for foreign investors for sure. So venture investments from global funds and global investors usually tries to go to the countries or regions where the convertibility of currency is good enough. And of course, you need to have a well-educated labor force. So the supply of people who can manage startups for rapid growth. And there should be a lot of entrepreneurs who want to sell significant amount of equity and psychologically be prepared to share control. That's actually one of the problems, that's so-called dilemma, entrepreneurs dilemma. It's when the founder should decide whether to give control or give sufficient part in the company to outside investors, but increase his chances of becoming rich with the growth of the company, or stay the controlling shareholder of the company, which will stay small in size. Psychologically, it's difficult. And not in every country, in every region, psychologically, people are ready to just share the control. If we look at that as an ecosystem, what it all makes venture capital work, it's everything, actually. It's investors, it's government, there should be large pool of capital, there should be entrepreneurs, a lot of corporations and strategic investors, R&D centers. It all should work together. And of course, there should be a public stock market as one of the avenues for exit, right? Otherwise, you will have only sales to other funds or only mergers and acquisitions besides bankruptcies. But IPO is the most promising exit. And of course, all investors want to at least keep in mind the chance that their investment will become large enough, fastly enough to make an IPO for them to have a successful exit. The chances of that are low, but if you have those chances, given your risk aversion or risk perception, given the risk perception, there will be people willing to participate in that. So naturally, this system will attract those risky capital. But if you don't have exit avenue, that might be a problem. The capital will go somewhere else. Here's just some rankings in Global Startup Ecosystem report of 2 reports. It's being issued every year. So ranking, of course, Silicon Valley. Okay, 6 years ago, Silicon Valley, New York, Los Angeles, Boston, and Tel Aviv were the top 5. There was Moscow yet. It was 13. But if we took the ranking 2 years after that, there is no Moscow already. And Beijing appeared as new, and Shanghai. So China picked up. Interestingly enough, Stockholm appeared at the 14th place. It's a quite dynamic ranking, but just I highly recommend you to get yourself acquainted with that if you're interested in the industry and nuances. And this was a nice picture I get from some presentation. I don't remember where from, but that's the idea how it all developed, right? It was mainframes. First of all, it was 1 million units. Then it was many more million units of personal computers. Then fixed internet appeared, networks appeared, then mobile phones. So it became even 5 billion mobile phones. So technologically wise, the larger the market becomes, the more interesting for investors at the early stage to be there, right? So now we are somewhere in mobile smart connected grids, which will include not only people like calling each other on the phone or chatting each other in Snapchats. It will be machines to machines, right? Or it will be automated systems, and it will be a huge different part, automated market without people. So new opportunities appear from time to time, and venture capital is really eager to be there and make money. So greed is everything in this situation, but not only greed. And these are just This is just a funny slide. I would say it's new power players increasingly expect to actually shape or create many aspects of their lives. So not only the industry and technologies, but also values of people also can change dramatically the industry. So the way people communicate or new markets can appear. So if you look at these things, we see that new power values might change some industries, right? So radical transparency is something against confidentiality, which we used to have before across the globe. Open source collaboration, crowd wisdom, etc. It's so the right chart is more close to your values, I would suppose. I am somewhere in the middle. I would presume that our parents most probably will have values on the left side of that interesting page. Thank you for your attention. That's it for today, guys. I hope it was a pleasure for you. At least it was a pleasure for me to again start teaching. That was first lecture. Appreciate any feedback. You can write in the chat. You can write in email. I think we will get together in terms of how we'll manage our information flow. But just to sum up, there should be a Google Classroom. That's from my side. From your side, it's be on time, give me feedback, then read things, read books, read papers, read articles, and make everything in time. I hope it will be a nice class for you as well for me. I'll see you soon next time, and appreciate you helping with other people to come to the lecture. As far as I get, about 20 people who are not here. It might be a problem if they continue doing that. Hopefully, it is not something we will be spending time on. Thank you very much, and have a great weekend.